For many, the stock market appears to be a wall of pure noise, a blur of flashing red and green numbers, dense jargon, and the constant threat of sudden financial loss. But allowing that confusion to keep you on the sidelines has a tangible cost. By avoiding the market entirely, you lose the opportunity to participate in the actual economic growth of India's largest corporations. To understand the system, we have to look past the flashing screens and focus on the single building block that makes the entire market possible: the share. A share is exactly what the name implies. When a company needs capital to expand, it divides its total legal ownership into thousands or millions of identical, micro-sized pieces. When you buy one of those pieces, you are legally purchasing a specific percentage of ownership in that actual functioning business. Entering the share market shifts your relationship with India's largest brands, moving you from the role of a consumer to that of a stakeholder with a legal claim to their corporate success. Facilitating the exchange of millions of these ownership slices every day requires a massive, centralized infrastructure. In India, the backbone of this financial system consists of two primary marketplaces: the National Stock Exchange, or NSE, and the Bombay Stock Exchange, the BSE. The NSE serves as the modern hub of Indian finance. Operative behind a sleek glass facade, it handles massive volumes through a high-speed digital network that processes the bulk of daily trading. The BSE represents the historical center of the market. Located on the famous Dalal Street, its skyscraper serves as a reminder of the legacy institutions that first built India's financial framework. With thousands of different companies listed across these two exchanges, investors need a way to quickly determine if the broader market is healthy or struggling. To solve this, the market uses tracking tools called indices, with the most prominent being the Nifty 50. This index focuses on a representative sample of the economy, tracking only the top 50 major companies to act as a diagnostic for the whole market. The logic of this barometer is simple. When the Nifty 50 rises, it indicates that India's largest corporate players are performing well. When it drops, it reveals underlying weakness in the broader economic ecosystem. Beyond the infrastructure, the most important question for any participant is how holding a digital share actually generates a financial return. This chart illustrates the primary method: capital appreciation. You buy a slice of a company and hold it as its value evolves. As the company grows, increased demand for its shares drives the price higher. This allows you to eventually sell your stake for more than you paid. There is also a second, distinct way to earn money from your ownership that doesn't require selling your shares at all. Many established companies pay dividends. This is where the business takes a portion of its actual operational profits and distributes it directly to shareholders as a cash reward for their investment. Real wealth in the market is the mechanical result of two factors: the market's increasing valuation of your asset, or the business directly sharing its success with you through cash payments. While the mechanics are consistent for everyone, the way individuals choose to interact with the market generally falls into two distinct strategies. Investment is a long-term approach. It involves putting money into strong businesses and holding those shares for years to benefit from the power of compounding growth. Trading is the high-velocity alternative. Traders attempt to capture quick profits by reacting to short-term, often daily, fluctuations in share prices. While both utilize the same stock exchanges, they require vastly different mindsets, levels of time commitment, and tolerances for risk. Regardless of the strategy, one reality remains constant. Every mechanism designed to generate profit carries an equal and unavoidable potential for financial loss. Market shifts or poor timing can visibly erode wealth. The red percentages on the BSE display represent moments where the market value of these businesses has contracted, resulting in actual losses for shareholders. This makes thorough research the most important rule of engagement. Investing or trading based on rumors or guesswork is the fastest way to lose capital in an environment that demands data-driven decisions. Operating within this highly structured ecosystem requires a commitment to the rules and a disciplined strategy. For those who track the indices and study the underlying businesses, the market remains a reliable engine for building wealth over the long term.